So what is a pension? Most answers are that pensions are funds that are designed to provide future retirement benefits. While that may be true, but what are the functions of a pension? How is it managed? And maybe to what objectives is it managed to? What are the unique risks associated with a pension? How can we better anticipate those risks? Hi, my name is Steve Peterson. I'm Director of Research for the Investments Team of the Virginia Retirement System. And those are some of the questions that we're going to address and discuss in this video.
So let's begin with a high-level view of some of the functions, objectives, and then maybe we'll talk a little bit about risks to pension management in general. So let's start with, what is a pension? Let's just define that first. So what it is that it is a contract between employers or a company and the company's employees by which both the employers and the employees contribute assets into a fund. Now, for an employee, that is typically a payroll deduction, and the employer generally matches some portion of that payroll deduction. So that over time, those contributions by the employers and the employees in this fund would tend to grow in line with the fund's assets. So typically a fund is going to have assets that consists of some kind of asset class, asset allocation, the largest of which is usually an allocation to public equity, which is just something like global stocks. It could also include fixed income instruments, which are just bonds. Private equity is one other potential allocation. Real estate has long been a fixture of pension plan asset bases. And lately, many types of credit instruments have found their way into these types of funds. So we'll talk about those in a little bit more detail. But the purpose of this is that the contributions are invested into these asset classes over the lifetime of the employees, upon which the employee retires, and then he collects through benefits, a retirement benefit, right, as a retiree, the proceeds of his account or her account as it was compiled in this fund over their working lives. So in general, there are two types of funds. There are plan funds that basically are defined benefits. That's the old style. And as of late, typically new employees are enrolled in a defined contribution plan. Now the difference doesn't matter to us in terms of how the math and how this works, so we don't need to worry about it. But just for your information, a defined benefit plan is one in which the employee receives a guaranteed income from the employer, right, from the sponsor of the plan upon retirement, no matter what his contributions do. For instance, as long as I contribute to this fund, it doesn't really matter to me what the fund performance is because that will not affect my benefit. Okay, it is contractually, legally obligated to have that benefit paid in full up front. All right. Now, for a defined contribution plan, typically what happens is that we both, again, share in this contributions to the fund. But at retirement, I basically am going to get some distribution from the market value of those assets upon the date that I retire. Right. That's the only difference. So let's take a look. What do fixed income instruments look like? We all know what stocks are, but fixed income instruments comes in very many forms. There are treasury instruments, right, which are riskless. There are investment grade and high yield bonds, IG and HY. There's mortgage-backed securities. There's emerging market debt. There are agencies like Fannie Mae and Freddie Mac. There are various types of fixed income instruments. All right, and they're all kind of pooled together. We just call it basically a fixed income fund. Right, it provides the diversification of public equity. That's why we have it there primarily. The other reason that pension plans have fairly large allocations to fixed income is that they look at the cash flows from fixed income, particularly in the form of coupon payments, and they can match the timing of those coupon payments to the timing of their benefit payments. Right, and finance has called liability-driven investment, but that's why fixed income instruments are so popular. In fact, if you go back about 50 years, most pension plans consisted of nothing but fixed income instruments in their fund. And it wasn't until later, when they were searching for yield or more return, that they engaged in asset allocation into public equity and also in real estate. But things like credit and private equity, these were kind of exotics, and they really didn't appear in those funds until fairly recently, over the past 30 years, basically. And again, this was all a search for yield. Okay, so we have the plan participants, and the plan participants are employers and employees, right? To the extent that it's a state plan, like the VRS, then there are also taxpayers, because the state, through the Constitution, the state Constitution, is legally liable for, paying off these promised benefits. And so if the fund comes up short, and the fund doesn't have sufficient assets to be able to pay benefits, then taxpayers are going to have to pick that up. So taxpayers, while they are not participants in the plan, they are indeed stakeholders. But the participants are just the employers and the employees. And for the state of Virginia, we typically group these into state employees. There's teachers, there's police, fire, and judges. So there may be different plans that are aggregated up. Some are local as well. Okay, real estate has private real estate, and it has REITs in it. It used to just be private real estate. In other words, we just own properties, but now we own actually allocations to publicly traded REITs or indexes. Credit, that consists of various types of instruments. I just gave a couple of examples here. Bank loans is one, convertible bonds would be another. So let's just leave it there. That kind of gives you a flavor for what the fund would look like, okay, and what the basic asset classes are. All right, so the overall health of the plan then is going to depend on whether the contributions and the fund growth are sufficient to cover the pension obligations or the benefit payments. That's the whole purpose of managing this fund, to try to achieve that end. So when we think about this, then we can define what the function is. The plan manages its assets to generate sufficient returns and cash flows in a risk-controlled environment that maximizes its ability to pay its liabilities. So the plan sponsor, in this case it would be the state of Virginia, appoints a board of trustees to oversee the function of the plan. And with the help of their actuaries, the board estimates the present value of future benefit payments to participants. I'll develop that in a little bit more detail later, but this is so high level that I kind of like to just give you a flavor for really what we're looking at here, okay, how we actually do this. Those details can wait a little bit. But what we're doing is that we can actually map out the future benefit payments of all the participants in the plan. We do that through our actuaries. We then present value that back. Okay. Then what the board does, they hire investment professionals who manage the fund, right, the assets in the fund. And those investment professionals also provide estimates of future fund returns. So this is the stuff, right, by which the board then can generate those benefit payments. So they first establish, well, what is the present value of those future liabilities? And then let's put together a fund, right, consisting of certain allocations to various asset classes that are going to be able to deliver the necessary cash flows to pay those benefits. The actuaries then determine what the contribution rates is going to have to be that will amortize those benefit obligations given expected growth in the fund over some amortization period. Typically that would be something like 30 years. Okay, so again, what we're doing here is that we first figure out, okay, over a 30-year period, what would be our our present value of all of our liabilities in the form of promised benefit payments. And then, given this particular asset allocation, how big will the fund grow, right, over that 30-year period at a given contribution rate such that the fund is sufficiently large enough to be able to pay those liabilities. So if the present value of the assets, which again is just the sum of the fund returns and contributions altogether, if that matches the present value of the liabilities, which is the present and future expected benefit payments, then the plan is what we call fully funded. This level is referred to as the funded status. In situations for which the present value of the fund's assets is less than the present value of its liabilities, then the fund has an unfunded liability, and the funded status is less than 100%. It's typical that most state pension plans have unfunded liabilities, and the worse shape they can be in, the higher the unfunded liability. So everybody's heard stories of certain states for which their unfunded liability has grown so large that there really is very little hope that they'll ever be able to amortize that given any reasonable rate of return over the amortization period. And so the funds effectively become insolvent, because they can't pay those future promised benefits. So one of the Board of Trustees' objectives then is to try to minimize the unfunded liability, or at least be able to amortize it going forward. And that's what I want to explore in a little bit more detail. Okay, so let's review. What are our objectives? What goals do boards of trustees manage to? Well, the plan liabilities are relatively easy to determine, right? In other words, the plan actuaries model each participant, right? Each participant, each employee has a current service. In other words, they've been in the organization for a certain number of years and they've already contributed a certain amount of their pay along with the employer's contribution, right, up to the current point in time. And then what they can do is they can look at their future service obligations. They can add those two together. In other words, suppose I've been working at the VRS for 10 years. I've been making contributions into the fund. The employer has been able to match some of those contributions into the fund, right? And then I expect to work, let's say, for another 15 years or another 20 years. That would be my future service. And so we would actually make estimates about how much my salary would grow over that extended period of time into the future, how much I would be contributing then given the current contribution rates, how much the employer would contribute given the current contribution rates. And they can present value that. In other words, they can figure out pretty much how much my assets are going to grow in the fund over, my current service and my future service. So they can figure out how much we're going to be contributing over our working careers. And then they will be able to figure out how much that we will receive in monthly benefit payments throughout our retirement years. Right, so that's pretty simple. In other words, we can do that for every single employee because we know how old they are. We're assuming that they're going to stay in the plan, right? So we make some assumptions, but we can kind of figure out what that liability stream is going to look like, because it basically just depends on demographics and mortality tables. So liabilities are relatively insensitive to the outside events like market movements and business cycles. That's my point here. Okay. On the other hand, if you look at the other side of the balance sheet, which is the asset side, those are not insensitive. Asset levels and therefore their returns and cash flows are going to respond to market movements over the business cycle, including things like the current pandemic, recessionary forces, market dislocations, policy changes, investor sentiment. The list goes on. So while liabilities are relatively stable, and I can map those out, it is the asset side that really contains most of the risk. So the Board of Trustees with investment staff are going to determine an asset allocation that is expected to achieve a targeted expected return going forward at a targeted risk level. And then that fund will grow at a rate that will pay the promised benefits. So it's sort of like a programming problem, isn't it? We have to figure out what an asset allocation is that's going to deliver those promised benefits. And all that is that it's a set of weights. So if I go back to the fund and I look, well, the fund consists of various asset classes. It has a public equity class. It has a fixed income class. It has a real estate class. It has credit strategies class. It has a private equity class. Notice it has all these classes. It's just the weights. How much of the fund do I invest in each of these asset classes? Okay, that's the asset allocation. They determine that every year. The expected returns are future expected returns. In other words, we figure that out. We have estimates for each of the asset classes going forward, let's say over the next 10 years. That's typically our horizon. So knowing or having a good idea about what we think this asset allocation will deliver, right, through these expected future returns, we get an idea of how much the fund is going to grow by over the next decade. And so we can then match that growth to, let's say, changes in our liability stream on a present value basis. So if I weight the expected returns, in other words, I take the sum of the asset allocation weights, right, the weights to each of those asset classes times each asset class expected return, that gives me an expected return to the total fund. Okay, so we target that. We try to achieve a growth rate of the fund that is going to be sufficient to pay the growth rate in our liabilities. And then we use things like correlations across the asset class. We weight those along with the asset class risks to get a targeted risk to the fund. So the board does a lot of things here at once. They're basically targeting, right, what an expected return is going to be, conditional on what we think the individual asset classes are going to return in the future and how much we are committed to each asset class through the asset allocation, as well as the risk. We need to target risk, and the purpose there is that, as we'll see in my example below, that the risk itself is the risk that our fund may not grow to a level that would be sufficient to discharge those obligations. Okay, so we want to target a risk level that we think we can manage. And the risk itself is measured as the standard deviation of returns to each asset class. That's a typical risk. We look at the historical returns, we get a standard deviation, and when you do that, the public equity, the private equities, the equity asset classes tend to have the highest equity risk premiums and therefore the highest risks. So if you're looking and searching for higher yield to an asset class, generally the trade-off is that you have to accept a higher risk. Okay, so there is really the challenge here is to try to achieve a reasonable expected return and manage its risk. So if I continue this, the fund's primary objective is to remain solvent then. I mean, that's really what it boils down to. It wants to pay its liabilities. And so in order to achieve that objective, the Board of Trustees must assess the expected returns and risks at the asset class level. They model the growth of the fund and its future cash needs through time. And then we arrive at a recommended contribution rate that will minimize risk and meet all of the risk of not meeting the liabilities. Okay, so there's another thing that's going on. So there are expected returns that are involved here. There's the over the future, let's say 10-year period. There's the asset allocation. There's the growth of the fund. All of those things are intertwined. Okay, and then I'm going to model my future cash needs. That's really to pay those benefits. And I want to choose a contribution rate then, the amount that we take out of our pay and the amount that the employer actually contributes that is going to minimize the risk of not possibly meeting those promised benefit payments. So the trustees must also assess the potential impact of market risks as well. So the funded status and any unfunded liability. I'll give you an example of that in a few slides. There is also the instability in contributions and contribution rates. In other words, if there is a market event, so that the fund loses value, then that creates a large unfunded liability. All right, and then therefore, to be able to amortize that unfunded liability, we're going to possibly increase the contribution rates. That means that from year to year, from point to point in the business cycle, then the contribution rates themselves become volatile, and that's we desire to keep those as smooth as possible. All right, I'll give you an example. Liquidity status. What does that mean? Liquidity is really the cash. So fixed income is a highly liquid asset class, and the reason is that we get regular coupon payments. Those are cash flows. So any asset class that basically produces a frequent stream of cash flows and can be liquidated close to its market value is what we call a liquid asset. Okay, other asset classes like the privates, like private real estate, private equity, they are a lot less liquid. Some credits are less liquid. Okay, so we have to maintain and we have to monitor what our liquidity status is. There's when you have to write a paycheck, a benefit payment to a retiree, you want to make sure you have the money in the bank and that you don't have to go out and try to liquidate an illiquid asset and lose a lot of value trying to sell that asset, because you may have to sell it way below its what you think the market value would otherwise be. So finally, the Board of Trustees must assess non-market risks as well. And these are demographic trends, changes in demographic trends, policy shifts, conflict, pandemics. All right, so we have both market risks and non-market risks, and this is the stuff of scenarios really where we try to anticipate going forward what these risks might be and how they might impact the decision factors of interest to us, right? And those are things like funded status, the growth rate of the fund itself, an unfunded liability, the contribution rates, liquidity. These are all the important switch points that the board tries to manage through its asset allocation. So having that behind us, let's look at an example of a market event and a response. So I picked the 2008 financial crisis. So I can give you a couple of statistics here. Right, the crisis of 2008-2009 resulted in significant loss of asset value to our fund. That was something that we didn't really anticipate. Here are a couple of numbers, and this would probably shock you. In November 2007, right, at the end of October in 2007, the S&P 500 peaked in value. From November 2007 until March of 2009, so it was less than about 18 months. Okay, that fund continued to decline. So the S&P, which is a large publicly traded equity index, lost approximately half of its value over that period of time. Within our fund, our public equity sleeve, that asset class, lost about 48% of its value over that same period of time, November 2007 to March 2009. The fixed income asset class, on the other hand, gained about 3% in value. All right, so those two that's the diversification, right? And in fact, it was then that you'd realize that you wish that you had a much higher allocation to fixed income, right? And so if you had a higher allocation to fixed income, at least those assets didn't lose any value. In fact, they gained value, but not a lot, but they gained 3%, and I'll take that rather than lose almost half of what I already lost. Okay, so that is the power of the asset allocation. Real assets lost about 28.4%. Private equity lost about 15%, and credit strategies lost about 23%. And so we were losing value in all our asset classes over that period of time, except for fixed income. So there was a significant loss in asset value, and that resulted in significant liquidity losses. When you lose value, then you basically, liquidity evaporates. And especially during a time like that, when there's a lot of panic in markets, you don't want to be a seller, right? Because nobody wants to buy. And therefore, you're going to have to sell something to raise liquidity. You're going to have to sell it at a fairly steep discount. And that's where liquidity comes in. So we lost a lot of liquidity. We had our funded status really took a negative hit because of that loss. And we created a large unfunded liability that needed to be amortized over the next 30 years. And that amortization can only occur if we increase the contribution rates. It's the only way you're going to do it. You're saying, look, you lost a lot of wealth out of the fund. You had to replace that because your liabilities didn't change. You'll notice that in blue at the bottom. The liabilities remain relatively unaffected. So you're looking at a balance sheet in which the liability side stayed basically the same and the asset side took a big hit. So we have to replenish the asset side, and the only way we can do that is through two measures. One, you increase contributions. Two, you take more risk. You change your asset allocation. So the VRS response on the right-hand side was to reassess the actuarial position. That's the first thing we did. Okay, had to examine what would be the amortization now of this unfunded liability. What would that require us to do? And it would have required us to have a jump in our contribution rates. The problem there was that the state decided not to make an annual contribution that year. And the reason is that when bad things happen, and this was a big macro event because it was a credit crisis, that the state's revenue sources pretty much dried up as a result because the economy took such a big hit. all of the ensuing unemployment, right? All the benefits they'd had to pay through unemployment, the fact that their tax revenues were down, etc. And so their revenue position really suffered as a result of that crisis, and they were forced, because of budgetary concerns, to not make that particular contribution into the fund that year. So here we were in a situation in which, we were requiring not just an increase in contribution rates, but we didn't get anything. We didn't get the increase. We didn't get the old contribution rates. We just got zero. Okay, so that really took another hit, and that was something that we didn't anticipate, and nobody really would, because this is sort of an exogenous risk. We had to therefore revisit the asset allocation to reposition for the recovery. So we knew when markets recover, they tend to recover pretty fast. You want to anticipate, well, which of those asset classes, right, should we be overweight to? Which ones how fast are they going to recover? And can you participate in that recovery? We had to review all our risk assumptions and all our expected returns again. We were coming out of that, the recession. The NBER, for instance, dated the end of the recession in June of 2009. So it was a fairly short but very steep sell-off in markets and a very steep recession. It started to recover in 2009, but arguably, it took about 10 years for us to really recover back to where we were. And then the pandemic hit last year, and so we're kind of re-experiencing this, but through different means. Okay. And so then we had to condition on a new asset allocation to address the liquidity position. So everything was on the table, so to speak, during this particular event. So you can imagine that if you're, thinking about a pension plan, here are all of the factors that were in play. The functions of the plan, the objectives of the plan, the decision factors of the board, what they're trying to manage to. And then this is an example of an event that occurred out there and its impact on the left-hand side on some of these decision factors. Right? And then what typically, an asset manager needs to do, to respond to that crisis using the tools that they have at their disposal, which is basically the asset allocation. The asset allocation, though, is going to depend on the expected returns. It's going to depend on the risks, right? And it's going to depend on whatever the contribution rates are going to have to be set at to be able to amortize that unfunded liability. All right. So today in 2020, the VRS fund has recovered almost back to its the point it was in 2007, just in terms of our funded status. And we've recovered a lot of that unfunded liability. And right now, I believe that they were running at about an 80% funded status, which is really quite enviable for state pension plans. All right, so that concludes part one. I hope that was helpful, and we'll follow up hopefully with other parts as needed to bring you on board. Thank you very much.